You're listening to the summary of the interview. For a link to the full-length episode, please check the description below.
Welcome to another episode of Investing in Regenerative Agriculture, Investing as if the planet mattered, a podcast show where I talk to the pioneers in the regenerative food and agriculture space to learn more on how to put our money to work to regenerate soil, people, local communities and ecosystems while making an appropriate and fair return. Why my focus on soil and regeneration? Because so many of the pressing issues we face today have their roots in how we treat our land, grow our food and what we eat. And it's time that we as investors, big and small, and consumers start paying much more attention to the dirt/soil underneath our feet.
Before we get started, I've been recording these interviews next to my day job, and I will definitely continue to do so and release about an episode a month. But at the same time, I would love to take this further, share more interviews. There are many more stories to share on investing in regenerative food and agriculture. More depth, improve the quality, maybe even doing some video series. So I started a Patreon community, which makes it easy to support creators like myself. If these podcasts have been of value to you, and if you have the means, I invite you to support me and make this happen. For more information, please find the link to my Patreon account in the description below.
And now, without further ado, the interview. Enjoy!
Today I'm talking to Aymeric Jung and Josep Segarra of Quadia Capital, an investment manager based in Geneva, Switzerland, who invested over 150 million into impact companies, projects and funds.
So I can start and just to let you know that before working at Quadia, I was working around 20 years on capital markets and the trading room, mainly on the structuring side. So it was really about looking for solutions. And in 2007, what happened? We had a crisis, food crisis, with pricings going up for all the food, and more private equity funds came to my desk, to my team, to structure a solution about buying land and produce food, because it was clear that population growing, pricing going up, it was a key investment 10 years ago. And on my side, I just found out that having a quantitative solutions, which is just producing more food, is not sustainable, and it's a short-term view about solutions that we should implement. And step by step, still working at banking, I met a lot of people about agroecology, local food, regenerative agricultures, and I do think that's the solution. And I started to be passionate about quality instead of quantity, logistic instead of just a linear economy where you are producing and then you waste. And I started to think that we should bring investment to all these new entrepreneurs who are reinventing the food system, and that's what I'm doing now. And when you really look at what we need today and what's going on, a big waste of energy is in the food system. Just all the oil you can use and need for growing the food, then the logistic and transporting food from one place to all around the world, is a big waste of energy. Yeah, of course. So after 2007, I left 2008, and the banking I mentioned before, I was at Lehman Brothers, so it was really in London, at the trading room, at my desk, living the crisis. So it was not so easy, but...
Wow, you were in the first row.
Yeah, exactly. The famous Monday in September. But for me, it was not really sad finally, because for 1 year I was already interested by something else. So I had this passion about how to bring solutions, this time not just through derivatives or pricing, but really on the field with entrepreneurs. First, you have to know, and I do think you know this, when you are talking with people or classical investors or bankers about social and environmental finance or impact investing, you have this thought that it will not be liquid, it will be with a low return, or just an emerging market with high risk, and sometimes not really professional doing this kind of investment.
More as a hobby, yeah.
Yeah, 5 years ago, it was really the case. What we did with Nouriter is just trying to find for an investors where is his comfort zone. And the comfort zone, it's not for investing too long and having a clear view on the potential return. So we built this program by bringing diversification for the investors, and the key was investing for 4 years, targeting a 4% annual return, and already some cash flow after 2 years and 3 years. So when you invest 100, the Nouriter program is giving you back 25% after 2 years, 70% after 3 years, and full redemption after 4 years. So for a lot of investors, it made sense to have diversification, I would say in real economy in their portfolio, and they knew that the return and the timeline of the return was really clear. So it's what we call the comfort zone of the investors, for them not thinking that it's too much risky at the beginning.
And that liquidity piece, like it's very unclear in many cases, because it's such a long-term transition, the food system, when it's coming back. So tackling that one is absolutely key. And how are you doing that? How do you make sure that after 2 years or 4 years already most of the money, or after 4 years, all of the money plus the return came back?
So we're structuring it in a way that we are only investing in debt in this program. So we more or less half of the portfolio, a little bit more, is allocated in direct loans to young companies normally looking for working capital funding. So in growth phases, where of course the banks are an alternative, but they need sometimes quicker capital and also partners that understand the business and their needs in terms of network and where they are going at. And the rest of the portfolio is actually allocated to debt funds, which give this liquidity component too. And of course, the way we structure the loans and the repayments match the cash flows that we want to obtain and reimburse to investors. So the whole pack allows us to structure it in a way that capital repayment is possible from year 2 onwards. So it's roughly 1 year period investment and over the 4-year horizon of the vehicle.
Another specificity we have is we are doing index debt. And index debt means that you are not discussing an interest rate with the entrepreneur. What you explain is you just need a risk premium, and the entrepreneur must pay back the debt with this risk premium. For example, it could be 20% for 3 years or 3 years and a half, which is the maximum maturity we are doing for our 4 years program. And it just means that the entrepreneur is borrowing 100 at the beginning, and for 1 year there is no cash flow, so he can really grow his company. We don't need some cash back for the first year, but after 1 year, every 6 months, he will pay back a percentage of his gross sales. So it means if the company is more successful than what we checked on the business plan, instead of 3 or 3.5 years, they will be able to redeem after 2 years, and it will be a high return for us. But it's a high return you are doing thanks to the company's success, not because you were negotiating at the beginning high interest rate. So by doing this way, a lot of entrepreneurs understand that perhaps the price of capital would be higher, but it's always cheaper than equity, but could be higher than just interest rate. But they are happy to share this because it's higher, because they are more successful.
It's also a way for us to screen companies to see how they advanced and why not consider an equity investment in the future.
So it's also a learning curve for our investors starting with Nouriter, their comfort zone, comfortable program, and now ready to go to more private equity deals because they are confident in our expertise and the companies we are bringing for investment.
Just listen to the summary of the interview. For the full-length interview, please find the link in the description below. If you found the Investing in Regenerative Agriculture and Food podcast valuable, there are a few simple ways you can use to support it. Number 1, rate and review the podcast on your podcast app. That's the best way for other listeners to find the podcast, and it only takes a few seconds. Number 2,
share this podcast on social media or email it to your friends and colleagues. Number 3. If this podcast has been of value to you and if you have the means, please join my Patreon community to help grow this platform and allow me to take it further. You can find all the details on patreon.com/regenerativeagriculture or in the description below. Thank you so much and see you at the next podcast.